Uh, this thought came in when I was meeting Prem and Anita both, and we decided that if it's an alternatives conference, there's always a mention for real assets. And thanks to the panelists, and I called each of one of you to be a part here, and thank you for accepting this. And now, just before we dwell into this particular topic, so real assets, of course, as you know, are tangibles, which could be infrastructure, could be real estate. Within real estate, there could be many things like Yash is doing warehousing and office space, etc. We also have land, which we're not going to discuss in this panel, but you can treat this panel also as a primer to real assets, because it's when you compare it to what sessions you've had since morning, this probably would be the most newest and not really exposed to from your side of things. So that's why maybe it could be a little primer when we start, and then we can go into details. But don't worry, we'll stick to the times which we have. Okay, so Yash, I just want to start with you. Now let's first concentrate a little bit on real estate, and then specifically, Yash does warehousing, and Yash, maybe you just want to talk to the audience. How do you perceive warehousing as an asset class? And then, of course, we move on to the other side of the real estate with Gaurav. So maybe you just want to give a little bit of feel on that and how investors make money on it.
Of course, of course. Thank you, Umang, and pleasure to be here today. Umang, like you mentioned, when you kind of look at the realm of real assets and real asset investing, I think the entire theme there is that you're investing in what is a tangible asset. Right? And therefore, because you're investing in a tangible asset, which is a physical asset which you can touch and feel, implicitly the amount of volatility which you would expect in this type of an asset class is usually much, much lower than what you would see on the equity side of life, right? And within the alternatives bucket, because alternatives frequently means that people are referring to venture capital and private equity, the volatility for real assets is, of course, significantly lower than venture capital and private equity kind of an asset class, which is obviously, much more riskier. And to that extent, returns on real asset investments have to kind of be looked at in that vein, right? So this is, not something which is going to create a venture capital return, right? This is not an industry where we are looking at generating multi-bagger returns. But yes, we are looking at generating, what are fairly attractive risk-adjusted returns, where you are able to get returns which are probably much higher than debt, right? But lower than equity and with lower volatility and risk than what you would typically associate with equity or venture capital or private equity type of investing, right? Now, within that scheme of things, of course, I have my two co-panelists who can speak on infra and office real estate more when they kind of talk about things. But from a warehousing context, I think the reason warehousing as a sector has seen a lot of interest from global institutional investors over the last 5 or 6 years, not just globally, but also in India. To give you a data point there, over the last 5 years, we've probably seen at least $6 to $7 billion of foreign institutional capital being committed towards the warehousing sector in India, right? So that's the volume of interest we've seen from global investors. And I think one of the reasons why investors like this asset class, both globally as well as in India, is on the one hand, when you kind of look at this from a demand-supply dynamic, it sits in a very favorable place to the extent that there isn't a whole lot of good quality organized warehousing supply which is available today. At the same time, given the boom which we have seen in e-commerce, given the boom in consumption in general, given the boom which we're now seeing in manufacturing, the demand for high quality warehousing and industrial real estate products is quite high, right? And that demand supply dynamic is then obviously in the favor of the landlord or the owner of these assets, which is a good thing from our perspective. The other thing which kind of makes this interesting as an opportunity is, unlike real estate where a lot of times when people think about real estate, people think about risk. And especially in the context of India, when you're looking at real estate development, developing real estate in India has obviously, always been very, very challenging, right? Whether it relates to approvals, whether it relates to, construction cost, timing, all of these things can pose significant risks. And warehousing is one sector within the real estate realm of things where some of these risks are actually far lower. And I say that mostly due to two reasons, right? One is that warehousing, at least the format which is kind of prevalent in India and the format which we run, is on what is known as a built-to-suit format, which means that once you buy the land, you don't actually build the building till you find a back-to-back tenant who is signing a lease commitment. And therefore, at the point where you are committing money to building the real estate, you're already fairly de-risked from a market standpoint. The other factor which kind of de-risks this is the fact that when you look at warehouses, these aren't really complicated projects, right? So these are basically industrial sheds or pre-engineered buildings or PEBs, which are built within a matter of months and not years, right? And which means that by definition, because these are less complicated projects with fewer moving parts, the risk of ending up with a meaningful cost or time overrun on these projects is usually that much lower, right? Which is the other large risk when you think about development real estate, right? So putting both of these together, what we see is that warehousing is a sector where we're able to generate fairly attractive risk-adjusted returns, where returns are in the sort of high teens to early 20s, gross of fees and taxes, while at the same time, they also look fairly de-risked from a risk perspective.
I think a fantastic explanation. Thank you, Yash. So basically what we're seeing is buy the land, go to say an Amazon, fix it up, build the warehouse, give it on rent to Amazon,
Absolutely.
and you make 16, 17%.
Absolutely.
That's basically fantastic. Now the same thing, let's kind of talk about space. Of course, he's given some advantages of warehousing, but I'm sure you'll have the own advantages of office space. Maybe you just want to talk about it, Gaurav.
Sure. So the first thing I want to mention from an office perspective, right, is that it's an extremely misunderstood asset class as far as India is concerned, right? Just imagine the power that the country itself wields on a global stage as far as offices is concerned. Offices is essentially infrastructure that houses services. Services is about 55% of our GDP. If you go back 20 years and take an analysis of how the country's GDP has grown, you'd find that offices have grown at 1.6 times the GDP, consistently over the last 15, 20 years. Right? That's how deep the connect of offices is to the overall growth of the economy, right? And that's how fundamental it is. And why is it that we are dominating the office space? We are about 50% of Asia Pacific right now, right? India is to offices what perhaps China was to factories not so long back, right? The fundamental reason for that is that we have a young population. We have a STEM-trained population. We have excellent demographics. Age is on our side. And we have all of this, which is English-speaking STEM population, low age, and a consistent delivery track record, right, which we've demonstrated over services. So there's deep moats that are propelling this journey. They have for the last 15, 20 years, they continue to, right? Unfortunately, in this kind of an asset class, and this is the kind of resilience and the opportunity that it offers, it's about $100 billion right now. Just to kind of throw up another data point, if $100 has come into the country over the last 5 years, 56% of that has gone into offices. And 44% is all other sectors combined. Right? That's the dominance that the sector had. Now, in such a dominant sector, in such a deep sector with $100 billion, 800 million square feet of stock, domestic investor market share from an institutional perspective is 18%, 1/8. 82% of these high quality offices that are propelling our country's economy have been bought by global institutions, Blackstones of the world, Brookfields of the world, other kind of similar funds. And that's where there is a large opportunity. If you go back about 10 years and FII flows essentially dominating how our indices on the listed side behaved, if they pull out money, the indices go down. That is kind of the stage at which offices are here, and that's kind of the opportunity that offices present specifically from a domestic investor standpoint, right? Now coming on to the inherent characteristics of the asset class itself, inherently, how are you making money? You are making money through entering in at about an 8-9% yield, growing that yield about 5% every year, right? And these yields are growing through long-term registered contracts with MNCs who have ratings which are better than the sovereign rating of many countries, right? That's how secure your returns are. And on top of that, you have leverage available to amplify those returns because these are real cash flow generating assets, etc., right? So that's how basic really the story is. That's how kind of clear the opportunity is. It's just that a lot of global institutions have played this game much better over the last decade, and we have the rise of domestic capital now to kind of address the same opportunity.
Fabulous. So let me come to Abishek now. And infrastructure clearly is the biggest asset class, arguably, in real assets. And I'm sure our audience wants to know how does one play infrastructure?
Sure, thanks, Umang. See, infrastructure, I mean, before I get into the question of how to play infrastructure, just a couple of minutes on what exactly is infrastructure according to our definition.
Perfect. We always said that this is a primer, so you can start with the basics.
Yeah, I'll try that.
Yeah.
So in our country, and infrastructure is anything related to construction. But in the real purest way, infrastructure involves no construction. A project becomes infrastructure after construction is over and commissioning has happened. That is something that we need to identify. So in all humbleness, I want to say that Larsen & Toubro is not an infrastructure company. It's a construction company. We are looking at infrastructure as an asset class to invest in. We are not looking to construct anything. So that is something important to note. Other than that, infrastructure asset, the nature of the asset is exactly like a warehouse or an office space with a couple of differences, right? In an office building, for example, you have to build the office building, right? Here we have to build a road, right? In a warehouse, you have contract with Amazons or MNCs in the case of offices. Here we have contract with National Highway Authority of India, which is a government of India entity, central government of India entity. Our contracts are 15 years contracts. 15 years, there is no vacancy risk. Even if they want, they cannot excuse themselves from their payment obligations. So it's like an office building where you have a confirmed AAA counterparty having a 15-year contract with attractive rents. So it becomes a little bit more risk averse than the other asset classes that was mentioned. So you imagine an asset like a road or a power plant, like a solar power plant. So revenue of that is fixed because you have a contract. Solar contract is 25 years. So for 25 years, you know what you're going to earn and when you're going to earn. And the counterparty is who? Counterparty could be the likes of NTPC, which is a AAA entity, or the counterparty could be Solar Energy Corporation of India, which is again a central government entity. So the great thing is, once the asset is built and once the asset is acquired by infrastructure investors, then the revenue is fixed for a very long period of time. And because of that nature, getting bank leverage to further spruce up equity returns becomes that much more easier. So we are looking at an asset which is delivering a very healthy high teen returns with contract with central government, payment coming. You can predict exactly how much you will earn even 10 years from now. And that is the beauty of infrastructure investment. Now I'm going to just address your question, Umang, about how to play this. Now, there are 3 ways to play this. First is investors can go and buy listed companies which are involved or dabbling into infrastructure. But along with that, you get construction risk, you get EPC, working capital issues, etc., etc. Because there is very, very few pure play infrastructure companies that are listed in the country. The other way to do it is there are, and in the last 4-5 years, it has become very much prevalent, an investor asset class called InvITs, Infrastructure Investment Trusts. At the moment, there are around 20 of those. Some of them are publicly listed, so you can go and trade like you would buy any stock. And some of them are privately listed. You can still buy them, but you'll have to source them because they're very closely held by very select few investors. Now this offers a very interesting exposure. So you are not exposed to construction. You have exposure to several infrastructure assets which may be diversified and located all over the country. And whatever cash is produced, that is upstream to the investor. So you get a very healthy return. So the dividend yield is very high. The third way to play it is through alternative investment funds of SEBI or the category 2 or category 3 funds as the case may be. But these are specific funds where investor capital is pooled, and using that capital we buy infrastructure assets which are operating. So these three ways of playing infrastructure is available for domestic investors.
No, perfect. So now I just want to dwell, so what he mentioned about InvITs and AIFs, and the same thing in your asset classes would be REITs and AIFs, right? So there is obviously IRR bump up when you do an AIF into a REIT or an AIF into an InvIT, right? So maybe any of you, or maybe 2 or 3 of you, or all of you maybe want to just explain this phenomena which is happening from a pre-REIT to a REIT or pre-InvIT to an InvIT.
Yeah, so Umang, I think there are a couple of aspects, right? So one is that REIT or a InvIT as a vehicle by definition is meant to basically not carry a lot of development risk or construction risk, right? So by regulation, a REIT or a InvIT, must necessarily own assets which are completed assets, right, and which are operating and rent generating assets predominantly, right? And to that extent, of course, the risk is lower, and commensurately the return you'd expect out of that instrument would be proportionately lower, right? On the other hand, when you're looking at an AIF, AIF is obviously sort of a little bit of a more bespoke structure, right, where you're able to control the mix of assets which you'd like to target, right? So for the sake of argument, you could have an AIF which has only completed assets, right? Or you could have an AIF which has only under construction assets, or you could have an AIF which is kind of a mix of both, or varying across the spectrum, so that you can calibrate the amount of risk and return you are kind of targeting through that pool of assets or through that strategy, right? So one is, just by looking at calibrating the underlying asset, right, to kind of pick where you'd like to be across the risk return spectrum on your strategy. The other aspect is, of course, that generally, when you look at going from a AIF, which is a privately held structure, right, to public listed InvIT or a REIT, which is a publicly listed structure, there is some amount of bump up or in value which you'd expect going from private to public, right? So often the strategy which a lot of these private equity funds have also employed, if you kind of look at the office side of things, where we now have like a, I would say 15-20 year track record of first building these assets and then consolidating these assets, and then finally these assets have landed up into your REITs. What a lot of these funds have done is that they have consolidated and created large private pools, right? And ultimately they have been able to exit into the InvITs, and through that sort of exit, there is an arbitrage between the private to public, which you are able to capture in terms of a value bump up.
So just to maybe recap what Yash is saying is, so of course when you're doing under construction and then letting it out, probably the rent on your cost of construction might be 15-16%. When you make it into an InvIT and IPO it at 10%, it's like selling a bond of 16% to 10%, you get a huge capital gain. So that's what it is. But when we go into not taking the construction risk, and Gaurav, I want to come to you on this. You're not taking the construction risk and you still want to play before a REIT. How much of a bump up is possible, and how does one play that?
So the difference, just to kind of elaborate further on that whole REIT versus a kind of an AIF point, is that a REIT is almost like a dividend stock, right? It's reached stabilization. It has very stable cash flows, but you can't expect growth, right? Because growth will always be muted in anything that is giving you regular liquidity. an AIF, and where a lot of AIFs are playing on the office side, is to give you that growth. So these are growth stocks compared to a dividend stock that a REIT really is. Essentially, how to play that, just from our perspective, is to come slightly earlier in the value chain. If you see the value chain of an office asset, right, you acquire land, you kind of take approvals, you develop it, the asset kind of is fully developed, right? Now, developers really play this role really well. Kind of, these are local issues. They are kind of very well versed with it. They're very apt at getting an asset to this stage, which is completed and maybe partially leased, etc. Right? But that is where the developer's role typically ends, because they are attuned to selling stock. This is inventory for them, right? They are attuned to selling stock on completion, and that's really where an AIF comes in, which is taking on these completed, partially leased assets, ramping up the leasing, stabilizing the operations, really making a trophy asset of that office acquisition, etc., and exiting it to a REIT, to another annuity investor, etc. Because then at a stabilized state, it is a yielding, low return asset, and that's where really we are playing.
Yeah, and maybe just to add to that, so I think at that point, right, so once a AIF has acquired sort of a partially completed, partially leased asset, and once they have completed it, once they have stabilized the lease up, etc., at that point, I think, to be honest, I don't think there is much delta which exists today, right? So whether you're buying an asset in a REIT or whether you're, buying an asset through an AIF, if you're buying sort of a institutional quality, institutional sized asset which is stabilized, you would expect to buy a commercial real estate asset at anywhere between a 8 to 8.5% cap rate or yield, right? So there, I think once the asset kind of reaches that stage of maturity, then I think the delta, whether you're holding it as an AIF or holding it as a REIT, that may begin to sort of practically become quite small.
Got it. I think,
Sorry.
yeah,
Umang,
sure.
I just want to mention a point. So this is where infrastructure AIF and InvITs are a bit different from what was mentioned. Infrastructure AIF also acquires typically, I mean, they can do construction as well, but typically whatever AIFs are there in the market today, they are doing mostly operational projects. And there is a delta between AIF returns, what investors can expect, and what InvIT returns can expect. So it's a trade-off. AIF returns are at least 5 to 6% higher than InvIT returns, but in AIF you are locked in. Because AIF, all the investment is done, so if you want a redemption, it's not possible. But in an InvIT, you can trade it on the exchange.
So I was coming to you actually. So the way Yash explained, it was a construction risk, and then hence, you're getting the maximum bang for the buck. How Gaurav explained was he was partially leased. So of course, if it's a 50% leased out, and then you take it to 100%, the value of the building goes up. But how does that happen in infrastructure?
So in infrastructure, Umang, there is, like I was mentioning, there is no tenancy and there is no construction. I mean, construction is over, tenant is government, right? So there is no risk as to speak in case of revenue, even when an AIF buys. But the dynamics of the transaction is what gives us the higher return. See, when the infrastructure assets are constructed, typical construction players are the tier 2, tier 3 construction companies. They're not like the L&Ts of the world, but they are, mid-cap construction companies. When they build an asset, a large amount of their balance sheet has to be invested to construct their asset. And their DNA is not that of an investor, their DNA is that of a construction player. So to do more projects, they have to recycle their capital. So once their project is done, at that moment of time, they are in a rush to sell the project because they need that capital to build more new projects. So at that point of time, it is basically demand-supply dynamics that we are able to get a better...
So is it maybe, if I'm understanding this right, so is it basically because you have ready capital and you're solving for somebody's capital issue and then pooling in a lot of projects together and hence playing the gap game?
Absolutely right. You put it in a nutshell very well, in fact, better than I could have. You're solving somebody's capital problem. That's the best way to put it. And as an AIF, we have certain advantages in terms of debt. So a construction player cannot take debt at the same terms that an AIF can. Because construction player has different risks that the bank perceives with them. So we can optimize the debt, we can solve the guy's problem, we can get a good deal, and because of this financial optimization that we can do, that's how we drive the returns.
So as we had mentioned, this is a primer, so hope we try to explain both the growth side as well as the dividend side. So dividend, obviously, it becomes a rental yielding, dividend yielding stock when the construction risk is out, and there are, of course, many ways to play the final destination. Now we move on to the risk side of this. So maybe let's start with office space, and we are seeing this work from home culture and many other things which are coming up, and you're not having, there's hot desking and so on and so forth, these terms which have come in post-COVID. How is that impacting future absorption on commercial estate, real estate?
Yeah, so very interesting, and that's why I said office is a very misunderstood product as far as India is concerned. Pre-COVID, we were leasing in the country about 57 million square feet on an average. This is how we went into COVID. This is 2018 and 19s of the world. 2000 cut to COVID and post-COVID as we stand today, 2022-23, we're leasing on an average 72 million square feet, right? So after every crisis, Indian offices have only become better. And you can go back to the GFC crisis actually and see the pre-crisis versus post-crisis occupancy levels. You can cut to the Y2K crisis and see the pre-crisis and post-crisis levels. After every crisis, essentially, it's realized that the work can be done better, cheaper, and in a much more manageable way out of India, right? So that's one bit. And we've actually, through offices, gone through the worst that was possible over the last 2-3 years. We've come out with higher absorption. We've come out with more than 5% rental growth, registered rentals all over the country. And we've come out with a 9 to 10% stock growth. And that's how we've kind of come out of offices. Again, from a risk perspective, one thing I'd like to point out is that because the markets are growing higher than contractual escalations, right, as compared to an infrastructure, a locked-in tenant isn't too valuable for us. Because once a tenant goes out, means we can lease up the space at much higher mark-to-market rentals. Today, in any market that you go up to, including BKC right here, you would want to have a tenant that's maybe leaving in the short term because the rentals go up much more than the escalation terms that are there in your leases, right? So from that perspective also, while tenancy is often in office perceived to be a risk, if you have the right product and if you are in the right market, it's actually an enabler to higher returns while being much lower risk. So that's how we are looking at risk from an office.
Perfect. So let's switch to infra, and of course infra, many challenges, capital intensive, long term, but of course all the funds are coming in post-construction risk. But there are still risks, like say, for example, you invested in a road and you assumed particular traffic assumptions of growth, etc. That could be maybe, I'm just saying that there could be risk. Maybe you could talk about risk to the audience and then how do you mitigate it. Second thing could be you're doing a solar project and the government's paying 40 days later and your IRR is not as much as you thought. So what are the risks in this and how do you kind of mitigate them?
So, Umang, you're right. There is a certain kind of road called a toll road where that risk is very much there. But very interestingly, in the last 5 years, NHAI has not come up with any toll road. So the roads that we are buying are called hybrid annuity roads where there is no linkage to traffic. I mean, whether one scooter goes on that road or 10,000 trucks on that road, my revenue is fixed. We don't care. Only job that we have to do is maintain the road. So that risk of a toll road is not there in most of the roads that are available in the market. And we as a AIF are only looking at that roads. Your other question was on the solar part. You are right. If we have a contract with a, you can say financially not so great state who delays payments, then yes, cash flows can become an issue. But in the history, no state has defaulted. Payment comes over time. But even then, this is a big risk. If some guy delays payment for 1 month, we still have to make debt payments and all that, so it becomes a problem. So that is why you have to go with the experience and track record of the fund manager For example, we don't buy any state. We buy only NTPC and SECI, where there is no delay. Solar Energy Corporation of India, for example, pays us on the 74th day. Now you'll say, why 74th day? 74th day because 30 days is the due date from invoice, and according to the contract, there is a 45-day grace period. So they utilize all of that and pay us on the 74th day. So that risk is also well managed.
Perfect. So I think I have time for one last question, and Yash, it's for you. So basically, when we look at, and on behalf of all of them, I think when you're looking at real assets, what variables are become important? Like inflation could be one. Where are you in the interest cycle, etc. So how, and on behalf, this is not only to warehousing. I think on behalf, what would these parameters be?
Yeah, so I think, for all of the real assets, I mean, end of the day, real assets in some way or the other, whether it is, office or infra or warehousing, are basically infrastructure assets of sorts, right, which are integral to the country's economy, which are integral to the country's growth, right? So in any form, when you're kind of looking at real asset investment, I think the general economic growth environment which you're seeing in the country, the interest rate environment which you're seeing in the country are always important factors. And I would add that I think, look, I mean, to be honest, given where the country is today, from a macro perspective and, where things are going, we're actually in a great place as a country, right? So you pick up any real asset you like. I mean, if you kind of look at it directionally over the next, 8 to 10 year kind of horizon, of course, during that time, there might be cycles, where there are ups and downs. There may be cycles of, higher occupancy, lower occupancy, higher rent growth, lower rent growth, right? But directionally, if you kind of look at it over a medium to long term, I think the prospects for, any of these real asset sectors which we're talking about today are very, very good.
Fantastic. Thank you, all three of you. And I hope we could explain real assets as much as we could in this 30 to 40 minute time window we had. But of course, we all are here. I don't know if we have time for questions, but we do. One or two questions. Okay, great. We can, and I already see a hand being raised. Yeah.
What is your view on fractional real estate that's coming as an asset class? I would not call it as a separate asset class, but and what is the incremental return that we are getting? So according to my assumption, 3 to 6% rental yield is what they are claiming to give, and 10% to 15% capital appreciation depending on the location and the type of real estate, whether it is commercial or residential. So I would love to know your view on this, since you all are experts in this.
So fractional is really just another medium to get exposure to commercial real estate. And when we say commercial real estate, it's a wider segment of opportunities, including warehousing, offices, retail, etc., right? The slight benefit from a fractional perspective is that you are knowing where you are investing. So it's an office complex on the Andheri Kurla road where you have a couple of floors, etc., right? So that's kind of the real benefit. A significant amount of disadvantages that one has. One is that you have a single asset concentration risk. Now any of the AIFs that we mentioned, whether infrastructure or kind of warehouses or offices, we're or REITs or InvITs, they're exposed to a multitude of asset classes, which inherently diversifies your risk, right? Which is better for you because that's how kind of these real assets operate. An FOP will directly give you exposure to a singular asset. It will give it to you at a subscale. So typically these will be floors within kind of a thing or a smaller warehouse, etc. And hence, just from an basic perspective, there are certain incompetitiveness associated. However, I think the regulation that has come of FM REITs is extremely progressive and forward-looking. They're wanting to get a lot of these FOPs out in the light from the dark in which they were operating in. And that's inherently good for the sector. It remains to be seen, though, how many actually make the cut and come out in form of a regulated stream. And that's a very important difference. All the AIFs are SEBI regulated, and approved, monitored, audited, whereas currently as the FOPs stand, they are a bit of a black box.
Yeah, I mean, just to add to that, see, I think the way to think about it today, if you are buying a fractional product, right, they are investing in an underlying commercial real estate, which is probably, leased out not to a Fortune 500 tenant, but maybe to, slightly smaller quality tenant of lower credit quality, right? And you would still be able to buy these assets at a yield of anywhere between, let's say 8 to 9%, okay? And typically you would expect, 4 to 5% of capital appreciation, assuming that the contracted rent escalations keep kicking in and the rents keep growing, basis that, right? And of course, if rents outperform, then you will see more capital appreciation, right? But if they don't, and if you assume that you're actually selling to the next buyer at the same yield, you will end up making a similar return, right? So, but I think as a product, I think it's a great product because it allows you to kind of pick and select and say that, okay, I'm looking at a particular, identifiable piece of real estate. But the question to ask is, should you be asking then for a better return compared to what you're getting from a REIT, right? And the way I would think about it if I was investing it is, yes, I should, right? Because it's a little bit like saying that, okay, if I'm investing in a large cap versus a mid cap or a small cap, of course, I'm taking higher risk in the mid cap or the small cap, and therefore I am expecting better return, right? So perhaps you should kind of apply that same lens to fractional investing as well.
Thank you so much.